Looking for a market-smashing yield near 5% in a low-rate world? Also want solid growth to go along with that big, fat dividend? Like the idea of buying a stock while it's on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a utility that's providing people with necessary power. Companies that provide necessary and ubiquitous products and/or services tend to make for great long-term investments. If you can't live without something that a company is providing, you're a captive customer. And if you're a captive customer, you have no choice but to basically open up your wallet. That means growing profits and dividends for companies in that advantageous position. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Pinnacle West Capital Corporation, which appear to be trading at a significant discount today. Pinnacle West Capital Corporation, stock ticker PNW, is a utility holding company that principally serves as the parent of Arizona Public Service, Arizona's largest and longest serving electric utility. With corporate roots dating back to over 125 years ago, Pinnacle West is now an $8 billion by market cap utility titan that employs 6,000 people. Pinnacle West serves more than 1 million customers. The company's one reportable segment is their regulated electricity segment, which consists of traditional regulated retail and wholesale electricity businesses engaged in electricity generation, transmission, and distribution. Residential customers accounted for 50% of fiscal year 2020 electric revenue, while industrial and commercial customers accounted for 49%. Other revenue occurred through wholesale, transmission for others, and miscellaneous customers. APS is vertically integrated, providing retail or wholesale electric service to almost the entire state of Arizona. Their service area excludes the Metro Tucson area and about half of the Metro Phoenix area. Fuel sources for APS for 2020 were as follows: gas 28%, nuclear 23%, demand-side management 16%, coal 14%, renewables 11%, and purchased power 8%. A significant portion of the company's energy mix comes from clean resources. Moreover, management has announced a plan for the utility to deliver 100% clean, carbon-free electricity by 2050. The utility business model and the investment thesis behind it is very simple. Our modern-day society cannot function without reliable power. By providing a basic need, a utility company naturally has a floor under the business. However, I think Pinnacle West has a rising floor, and that's because of its geographic advantage. Utilities are typically bound to a geographical area. In Pinnacle West's case, that's actually a good thing. Of the top 10 largest U.S. cities, Phoenix grew the fastest in percentage terms between 2010 and 2020, according to the most recent information from the U.S. Census Bureau. This means more captive customers coming to consume the energy that Pinnacle West provides, and that should result in the company being able to consistently grow its revenue, earnings, and dividend over the coming years. Pinnacle West has already increased its dividend for 11 consecutive years. The 10-year dividend growth rate is 4.2%, which is solid. Then there's the market-smashing 4.8% yield. This yield isn't just more than 3 times higher than what the broader market offers, it's also 110 basis points higher than the stock's own 5-year average yield. The moderate payout ratio of 67.5% covers the dividend handily. There aren't many stocks out there offering a yield near 5% right now, even in the utility space. For income-oriented dividend growth investors, this yield is notable and appealing. Looking at business growth, Pinnacle West grew its revenue from $3.2 billion in fiscal year 2011 to $3.6 billion in fiscal year 2020. That's a compound annual growth rate of 1.1%. Meanwhile, earnings per share moved from $3.09 to $4.87 over this period, which is a compound annual growth rate of 5.2%. Considering that this is a utility business, these numbers are good. Not excellent, but certainly not poor. However, because of the noted demographic trends playing out in Arizona, the next 10 years could be even better. Looking forward, CFRA currently has no 3-year growth projection for Pinnacle West's earnings per share. This is one of those rare times in which CFRA doesn't have that forecast. On one hand, CFRA speaks on the favorable service area, and I quote, "Positive economic development in Phoenix continues to attract new businesses to the area, which should support an expanding revenue base for PNW as business influxes typically pair with higher residential growth," unquote. On the other hand, Pinnacle West's regulatory environment has deteriorated. During their most recent rate case this past October, the regulatory body over there, ACC, decided to cut the company's allowed return on equity from 10% to 8.7%. CFRA estimates a 90-cent hit to this year's earnings per share from this decision. Utilities run local monopolies and provide necessary power to captive customers. It's easy to see how that could get out of control, so they're heavily regulated. This regulation can act like a pendulum depending on a variety of factors. Sometimes it's relaxed, sometimes not. It's a case of the latter right now. In this case, I see a tailwind, demographics, running up against a headwind, regulation. Pinnacle West will almost certainly continue to grow its base, but the rates they can charge the base will be lower for the foreseeable future. It is possible that the pendulum will swing back the other way in the future. Either way, the base will likely expand in the meantime. Putting it all together, I think the utility is positioned to grow the dividend at a mid-single-digit rate over the long run, which would be in line with the last decade. And with such a high starting yield, that's a compelling setup for income-oriented dividend growth investors. The big caveat here is this is a long-term projection. The near-term dividend growth could be relatively light while the company adjusts to the new ROE paradigm. After that shakes out and the demographic tailwind kicks in even harder, dividend growth should pick up. Moving over to the balance sheet, the financial position is good. It's what I'd expect from a utility business. The long-term debt-to-equity ratio is 1.1, while the interest coverage ratio is near 4. Profitability is robust, with margins impressing. Over the last 5 years, the firm has averaged annual net margin of 14.6% and annual return on equity of 10%. We already know where the ROE is headed, though. I think there's a lot to like about Pinnacle West, especially if you have an orientation toward income and could use more utility exposure in your portfolio. And the company does benefit from durable competitive advantages, including economies of scale, a geographic monopoly, and a regulatory structure that nearly guarantees some level of profit. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Regulation is a double-edged sword. Regulators allow for utilities to make a reasonable profit, factoring in things like CapEx. Profit tends to scale with costs. This puts a profit floor in place. On the flip side, there's a ceiling. Because power is necessary and there's often only one power provider in any one geographic area, regulators limit the rates a utility can charge. We have recently seen the ceiling become more prominent than the floor. Since a geographic monopoly is often in place, competition in the traditional sense is usually nil. However, customers could become competition in the future through the generation of power at the site of consumption. There's geographic risk here. Utilities don't have the ability to expand their coverage areas very much, so they largely rely on the underlying population growth of those areas. Fortunately, Pinnacle West has a geographic advantage. I also see pricing risk. The company purchases some of their power. This leaves them vulnerable to swings in natural gas prices. Lastly, there's nuclear risk. Pinnacle West has an interest in the Palo Verde nuclear plant, the largest nuclear plant in the United States. Many of these risks are pretty standard for a utility, and I think this name can make a lot of sense for long-term dividend growth investors. The rate case was a setback, but this was a $100 plus stock in early 2020, and the revenue base has surely grown since then. A miserable 2021 has left the stock with a very undemanding valuation, making it even more appealing as a long-term investment. The stock is trading hands for a price-earnings ratio of 13.8. That's well below where the broader market is at and where utilities in general are at. It's also way off of the stock's own 5-year average PE ratio of 18.1, and the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate due to the high yield and a long-term dividend growth rate of 4.5%. That rate is lower than the EPS growth rate over the last decade, and it's nearly mirroring the 10-year proven dividend growth rate. I see the demographic tailwind essentially canceling out much of the regulatory headwind headwind over the coming years, which should result in something akin to the status quo. Now, I think the near term could be shaky in terms of dividend growth. Indeed, the company elected to increase the dividend by only 2.4% in November, but I think this will smooth out over the long run. A mid-single digit long-term dividend growth rate is not a high hurdle for a utility to clear. The dividend discount model analysis gives me a fair value of $78.96. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates PNW as a 4-star stock with a fair value estimate of $78. CFR rates PNW as a 3-star hold with a 12-month target price of $71. I landed almost exactly in the same spot as Morningstar on this one. Averaging the three numbers out gives us a final valuation of $75.99, which would indicate the stock is possibly 9% undervalued. Here's the bottom line, guys. Pinnacle West Capital Corporation is a utility that's located in a very advantageous geographic area, with much of its service territory benefiting from domestic migration patterns. This is causing a lot of growth in its revenue base, with a market-smashing yield near 5%, mid-single-digit dividend growth, 11 consecutive years of dividend increases, and the potential that shares are 9% undervalued. This is a compelling long-term idea for income-oriented dividend growth investors. And now for a special news announcement. Lockheed Martin Corporation, stock ticker LMT, just keeps winning massive orders. Finland has now ordered 64 F-35 fighter jets, along with service and maintenance through 2030, in a deal worth a total of $9.4 billion. I recently called out Lockheed Martin as one of my top 5 ideas for 2022. Will the market reward the stock like it should this year? I can't say for sure, but what I can say is the business continues to fly higher and higher, pun intended. You might want to consider jumping on before it takes off completely. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.